Why do business metrics matter to startup founders? That's the question we're exploring today. Diving right in, we begin with the first business metric, customer acquisition cost, often abbreviated as CAC. This refers to the total cost of acquiring a new customer, including all aspects of marketing and sales. For example, if a startup spends $10,000 on a marketing campaign and acquires 100 new customers, the CAC would be $100. Next up is lifetime value, or LTV. This is a prediction of the net profit from the entire future relationship with a customer. If a customer stays with a startup for 5 years and pays $200 per year, their LTV would be $1,000. Quickly moving on, we have the churn rate. This is the percentage of customers who stop using a startup's product over a given period. If a startup starts the year with 100 customers and ends the year with 85, the annual churn rate would be 15%. Fourth in line is the burn rate. This refers to the rate at which a startup is spending its capital. If a startup starts the month with $50,000 and ends the month with $40,000, the monthly burn rate would be $10,000. Now let's discuss the revenue growth rate. This measures the month-over-month percentage increase in revenue for a startup. If a startup's revenue was $10,000 in January and $12,000 in February, the monthly revenue growth rate would be 20%. The sixth metric to consider is the customer retention cost, or CRC. This is the amount of money a startup spends on activities to reduce customer churn. If a startup spends $5,000 on customer service and retains 95 customers out of 100, the CRC would be approximately $53 per customer. Next, we have the gross margin. This is the difference between revenue and cost of goods sold divided by revenue, expressed as a percentage. If a startup's revenue is $100,000 and the cost of goods sold is $60,000, the gross margin would be 40%. Lastly, we have the Net Promoter Score, or NPS. This is a measure of customers' willingness to recommend a startup's product or service to others. It's calculated based on responses to a single question. How likely are you to recommend our company/product/service to a friend or colleague? The scoring for this answer is most often based on a 0 to 10 scale. Understanding and tracking these business metrics is crucial to a startup's success. Each metric provides a unique perspective on the company's performance and potential. These numbers can highlight areas of strength and reveal opportunities for improvement. They can guide decision-making and strategy development. Most importantly, they provide a clear, quantifiable measure of a startup's progress towards its goals. So yes, business metrics do matter to startup founders. They are the compass that guides the startup ship towards success. Voiceover. Now let's delve deeper into the concept of customer lifetime value, or CLV. This metric is the projected revenue that a customer will generate during their lifetime. It's an essential factor for startups as it helps determine how much they can afford to spend on customer acquisition while still making a profit. Next, we have cash runway. This is the period that a startup will remain solvent given its current cash burn rate. In other words, it's how long your startup can keep running if its income and expenses stay constant. Understanding your cash runway is critical for startups as it gives an indication of the company's financial health and how much time you have to turn a profit or secure additional funding. Understanding both CLV and cash runway can provide valuable insights into a startup's financial health. These metrics can guide strategic decisions, helping startups steer towards success.